how do I plan on managing the timing difference that I have between my payables? So, probably most importantly, payroll, which isn't forgiving. You got to pay everybody on time. And that usually happens sooner than when you receive money from your either your grants through agencies or even your clients. So there's a timing difference, and that can be anywhere from days to weeks or even 2 or 3 months. So, how you plan for that and how you actually manage it on a day to day basis is an interesting topic. And it certainly was for me when I was an entrepreneur and in a startup. Managing that timing difference can get pretty tricky. So, we wanted to talk about what that means to you, how you can think about it, how you can manage it day to day. And there are a couple of important parts to that thinking. One is understanding what some of the basic accounting principles and methods are so that you can actually determine what your timing difference is. And then second, what are the kinds of commercial arrangements, commercial borrowing arrangements can we make with banks or our bank in order to manage that smoothly? So we'll present this morning an introduction to accounting and a discussion of the commercial borrowing arrangements that commonly are provided by banks. And then, as a third topic, our bonus topic today is indirect costs. We'll actually hold that discussion to the very end to make sure that we have time. I want to make sure that all of our questions and answers are handled on the two most important parts, which are um, accounting principles and just a review of those, and commercial borrowing practices. We'll get into indirects as a last topic. But as a matter of introduction, for those of you who haven't met Dennis, Dennis Corley is a principal at Three Roots. Three Roots Capital is a strategic partner of the Spark Innovation Center. So, what that means is that Dennis and his partners at Three Roots are willing to invest their time and effort into helping our program and specifically your companies succeed. So, Three Roots doesn't get compensated for this, just like in prior workshops, PYA didn't get compensated for those. They're doing that because they are truly interested in your success and the success of this region. So um, we consider them to be strategic partners and good friends. And I hope that when you have needs that line up with what Three Roots delivers, that you certainly will consider them first. So uh, anything else on an introductory matter? I don't think we're going to have breaks today. So if you need to have a break, go get a cup of coffee or bio break. Please do it and just pop back in. I expect that this will take about 2 hours, maybe two and a half. And with that, Dennis, I'll turn it over to you.
Great. Thanks. Thanks, John. Thanks everybody for attending. And so this is like John said, this is just basically an introduction to accounting. And the reason why um, I developed this class. It's kind of ironic because people who know me for long term, me teaching accounting is pretty hilarious. I never had it in college, but it's a good example of why maybe you guys could benefit from this, even though it's pretty fundamental. Last year, or I guess one BC, one before COVID, we had conducted a series of events, in-person events that was entitled "Financing My Business." It was just a video series. We had some events and we recorded them with some experts. And those videos are available on our website. And it just talked about financing your company, the sources of capital, and those costs that are associated with those different sources of capital. You can see the four different series right here. And so, and those are broken down in short segments. So if you want to look at that bite size, you can. But as we developed those resources, it occurred to us that some of the language used in those presentations assumes a basic knowledge of accounting that maybe some people just don't have, not because they're not smart people, but they've never had accounting class. Like I never had an accounting class. So anyway, so we developed this class, and this class is based upon a book. I'll introduce that book to you. So learning the basics, the language of business. Like if you had taken an accounting class in college, the professor on the first day probably would have said, accounting is the language of business. So it's just the kind of the syntax. If you were a programmer, it's the syntax of your language. So a really good friend of mine who's a really bright financial expert says, if accounting is the language of business, finance is your story. And the story is very, very important. So if you have your own business, you need to know you're going to have to finance it somehow. So you need to have a good story, and you have to have the ability to tell it. So accounting is the beginning of being able to do that. And another point is, if you're a business owner, you need to be able to manage your business. So you need to be able to interface with your accountant, whether that's on staff or outsourced, or if you have a chief financial officer. You as the CEO need to be able to understand that language enough, not to do the accounting, but to interact with your accountant. And this is just a kind of a good side note. One of the nice things, because accounting is based upon specific standards, it's a very easy thing to outsource or to get a fractional accountant, a fractional CFO. So most of your small and even mid-sized companies don't have necessarily a full-time accountant. So anyway, that's something to be considered as you grow your business. So like I mentioned, this is based upon an awesome book. I don't know if you guys know me that well, but some of you know me. I don't like large books. I think books should be less than 200 pages. So this book by Mike Piper, in 60 pages of the 99, it's an awesome overview. So actually, I have copies of this. Anybody who wants to come see me at Three Roots, I'll give you a free copy, or you can order it on any potential site. It's a great book, very simple, good reference for you. So what's the definition of accounting? It's just basically a system to track your income, your expenses, your assets and your debts, or slash liabilities. And the basis, and this is kind of the basic principle, the founding principle of accounting and your accountants, your general ledger, as we'll get to. It's this accounting equation: assets equal liabilities plus owner equity, and it's everything's built upon this. So what are assets? They're basically all the property owned by the company. Your liabilities are any of your debts currently outstanding. And then the equity is just going to be the difference between after if the company's met its obligations, is there anything left? And that's owner's equity. So if we look at handout number 1, I've got some slides on it too, but you can follow along on your sheet. I left some stuff blank so you can actually do the work yourself if you like. So if I got Volunteer Plumber Company, it has 2 trucks worth $35,000 each. 1 truck's paid off, 1 has a loan on it. 9,000 is left on that loan. So additionally, they have $5,000 of inventory, and they owe their vendors $1,000. So we're just going to go through the accounting equation here. So the assets, maybe Don, if you've been paying attention so far, could you identify the assets of Volunteer Plumbing?
Sure. I would say the trucks.
Yes.
Right.
Anything else?
And the inventory.
Correct. So we have $75,000. Good job, Don. So y'all need to pay attention because I'm making.
Thanks. I pulled that one
out. So maybe Winnie, could identify the liabilities of this company?
Let's see. So it would be the 9,000 plus the 1,000.
Correct. Correct. So I'm not going to make anybody do the math, but assets equals liability plus owner equity. If you want to get the equity, just, you guys are very smart. Just do the math. So there's $65,000 of owner's equity. So it's kind of interesting, the term liability, and it just depends upon where you are in the transaction. So in this same transaction, there was $9,000 on a loan. So the loan on the truck is $9,000, and to the plumbing company, it's a liability, but to the lender, it's actually an asset. So a lot of times in accounting, and we'll get later on when we get down into debits and credits, you'll see that the context is really going to define its meaning. So, okay, so we've got the accounting equation, and the very first financial document we'll look at is called the balance sheet. And the balance sheet, this is important, it's a picture, a snapshot at a specific point in time of a financial situation of the company. And it's basically just a formal presentation of the accounting equation. It has three sections, just like the accounting equations: assets, liabilities, and owner's equity. So what are the assets? And they get broken down. And so there's cash and cash equivalents, anything that you can turn into cash very quickly. Inventory, that's stuff that you have ready to sell. And then there's property, plant, equipment, pretty straightforward stuff. Your liabilities are people you owe money to, notes payable to a lender, and then your owner's equity is amount invested by the owners in the company, and then retained earnings. And we're going to talk about retained earnings later in the presentation. But it's basically at the end of every year, we're going to calculate net income, and over the years you accumulate that, and that's referred to as retained earnings. And we'll see how that happens in a bit. So let's look at the handouts. I think I don't have the slide on this. I think just because it's pretty straightforward. So I kind of put the definitions up there for your reference, but just kind of looking, this is a very basic, simplistic version of a balance sheet. But I want you to just notice a couple things, how they're broken up into the three categories: assets, liabilities, owner's equity, that reflect the accounting equation. And the big deal here is if you go down, you see how assets are 480,000, you'll see that liabilities and owner's equity add up and they equal. So the balance sheet balances, so both sides of the accounting equation are in balance. So this will be a big red flag to your accountant or you. Hopefully it wouldn't get to you before your accountant had already brought up the issue, but if it was out of balance, it would be an issue. Okay, so kind of getting a little more granular, assets and liabilities can be categorized as current or long-term. And it can be helpful, as we'll see, to do that. And so how do you do that division? Where does it break up? It's generally, a rule of thumb is 12 months. You know, an asset that can be converted to cash within 12 months, or a liability that's expected to be paid within the next 12 months is categorized as current. And then non-current or long-term, sometimes they're used interchangeably. Anything that's not current is long-term. So it's kind of interesting. Notes like loans are kind of a little more complex items because they get broken up. The portion of the loan that's payable within the next 12 months is considered current liability, and the remainder of it's long-term liability. The notes also behave differently in other parts of the financials. We'll talk about that. So, and there's some flexibility in how this is named, company to company, ledger to ledger. So it's not all written in stone, but it can be customized. And that's why it's important for you to be conversant in this language, so that when you have a fractional accountant, that you can add value to how those books are set up. So let's look at the handout number 3. And again, just looking at a little more of this granularity. You see how these assets, like here you got cash and you got accounts receivable, those are going to be current. You know, your property and your plant, that's long-term an asset. What else? Here you can see how the note under current liabilities, the current portion of a note's payable, and then long-term is the non-current portion. So it's helpful to look at that from a strategic point of view, look at what's coming up, how you're doing about paying some of that stuff down. And again, obviously checking out, does my balance sheet balance? Do assets equal liabilities plus owner equity? So,
Hey, Dennis, I have a question. This is
sure.
Anna.
Yeah, hey, Anna.
So, okay, let's say, for example, like a fairly long-term loan, would you put like whatever's going to be payable in the next 12 months under current and then the rest of it under long-term, or would the whole loan, because it's long-term, go under like long-term?
Anything that's current in the next 12 months, you'd put under current. Anything that's not, you'd put it there. So you'd split it.
Okay.
Cool. Good question.
So Dennis, let me throw out another point, and maybe you said this before. I have to remind myself when I'm looking at income statements and balance sheets, and here we're looking at balance sheets. Balance sheets are for a specific point in time.
Yes.
They're not for a period. An income
Correct.
statement is for a period of time.
Yeah, we're going to get to that on the next
Okay.
the next one. Yeah.
Okay. So
But yeah, but it's a great distinction. I say it a couple of times in this presentation, but you can't overstate it because you need to remember that.
well, it's easier to remember than how liabilities can be split into current and long term if you
Right.
consider that the balance sheet is only a point in time.
Yeah, great point, John. That's a really great point. That helps that point get clarified. So awesome. Which brings up this point. And the thing is sometimes you'll see a multi-period balance sheet, and that's just it's a balance sheet, and we'll have an example of one with two columns, each representing a specific point in time. It's two different snapshots at two different time periods. So it can be useful to compare what's been going on in those two different time periods. And sometimes when you look at just the balance sheet for two different time periods, it may not be clear why those differences are, and you might need other financial statements to discern that. So let's look at, let's look at the balance sheet handout number 4. So this is put your thinking caps on. I'm about to call on you again. So I've highlighted a couple of things on here. We have a balance sheet. The right-hand column is the end of year 2012. The column to the left of it is the end of year 2013. So we're comparing these 2 years. And so I've highlighted a couple of things. This accounts receivable, man, it jumped up from 5,000 at 2012 and then to 20,000. So that's a pretty big jump. So maybe Marwane, how do you say it, Marwane or Marwan?
That's fine. Marwan is fine.
Marwan, could you give me some bad reasons why accounts receivable might jump way up? Something bad happened.
So if I'm so I get the point of the snapshot. So there's this I mean, it gives you the aspect of the
Right.
the financial aspect for a single point in the time.
Yeah.
It doesn't give you the overall picture.
Right.
I don't know how
So you can't tell, right? You don't know. That's why you might need some other financial statements to really figure out the real why. But I think there's some good reasons that could have happened to make this go up, and there's some bad ones. Like for instance, if last year were a COVID year and some of your customers who owed you money were restaurants, and they may not be able to pay you, right? And so accounts receivable might go way up.
Mm-hmm.
so that's an example. The other side of the equation, something good that may have happened is you may have grown your business. Your revenue may be 4 or 5 times higher. And so this accounts receivable might just be a normal portion of that. So this is kind of an example of why just looking at the balance sheet, I see something I want to know more about, but I may need some other financial statements to explain it to me. And part of the clue in on this statement is if I look at down here where I highlighted the retained earnings, if retained earnings went up in that same period, that's probably a pretty good thing. So I'm probably expecting something in those other financials to be more of a positive thing, like revenue went way up or something like that. But that's just kind of, hey, this gives me some clues as to it generates some questions that I need to research, and I'm going to need some other financial documents to really answer the pieces of the puzzle. Great. Does that make anybody have questions about that multi-period balance sheet? If it makes sense to everybody, if it doesn't, we can have some questions.
You need an agent report on your accounts receivable to answer that, correct? I don't know the proper name of the document, but it's account receivable agent.
Yes, great point, Brandon. And we'll talk about we probably wouldn't have talked about specifically aging until John was probably going to bring it up when I did the P&L or the cash flow statement. But you're right, aging accounts receivable, and that's a really big thing that banks will want to look at to see are you cash flowing. So great point. And those, I don't have that defined in here. It's not as rudimentary as some of this other stuff, but aging accounts receivable is just a history of how long has it taken you to get your accounts receivable paid by your customers. And that's a really good sign of a healthy business or a business that may have some things it needs to address. So great point, Brandon. All right. So now we've talked about the balance sheet. Another financial statement is the income statement. So as John pointed out, a really key thing to remember is that the income statement is a document for a period of time, and that's contrasted with the balance sheet, which is a point in time. So the income statement is also referred to as the P&L, the profit and loss statement. There's 2 sections in the income statement: revenue and expense. And so there's some concepts here, some terms. Gross profit. So gross profit is the sum of your revenues minus the cost of the goods sold. If you're manufacturing a product, it's more clear for that. And then the cost of goods sold is basically what did it take? What did the company have to pay to produce that good to be sold? So let's look at handout number 5 in your handouts. And I think I have slides on this. Yes, I do. Okay, so this is quiz time again. So we have Volunteer T-shirt company. It sells custom logo T-shirts. In 1 month, they ordered 300 T-shirts that were $12 each. By the end of the month, they sold all 300 for $7,500. Will, what is the cost of goods sold?
That'd be $3,600.
So exactly correct. And Anna, are you still on? Because your little logo. Oh yeah, there you are. Anna, can you tell me the gross profit?
So the gross profit is 7,500 minus 3,600.
Good job. Good job. Awesome. So now here's a little note. That's a pretty simple example. If a company doesn't sell all of its inventory in the course of the period, in this case, it was a month, but we might look at it quarterly or annually. So the cost of goods calculation can become more involved depending upon how you track your inventory. But this is an intro class, not an accounting class. Okay, and example number 2. So you got volunteer software development. They offer development by the hour. They charge $150 an hour. They sold 100 hours in a month for $15,000. What's the cost of goods sold, Don?
The hourly wage that you pay the software development people at your company times 100 hours?
It's a trick question. No,
Oh.
because it's a professional services thing. Technically, there are no cost of goods sold. That the salaries you pay is gonna be more of an operating cost, and we'll see that in a second. So it was a
Okay.
trick question. It's a trick question. So in a services company, the gross profits just is the revenue. Okay, so let's talk about operating income versus net income. So we're kind of getting a little more detail in our income statement. So operating revenue, that's the revenue generated by the sale of primary products of the business. And then operating expenses are the match that, the expenses that are the core operations of the business. And then there's non-operating revenue that you might gain from doing investments of your own as a company, or interest income on your deposits. That's non-operating revenue. And then there's non-operating expenses. You might have to pay interest expense, or if you had made an investment and you had a loss, that's where you would categorize that. So let's look at handout number 6 and just look at why separating it might be of value. And so here we have a little pretty simplistic income statement. You have revenue with your sales, your cost of goods sold. So you have a gross profit of $375. And then you have your operating, you have your rent, and you have your salaries, advertising, your insurance, and that's another 200K. So you have this operating income after your gross profit. From your gross profit, you subtract your operating expenses, and you have this operating income. But you also may have sold an investment, or you had to pay interest expense, and so that comes to the bottom line as well. So again, this is a simple example, but if you're trying to see if your primary company is operating at a profit, I'd be real interested in this operating income number, because if you had a net income that was positive but the operating income was negative, you may have had to do some creative things in the non-operating area to make things work, to keep the boat afloat. That's great that you did that. It was creative, whatever it was, but hey, this operating income, for it to be a healthy company, someday we need to have a model that's showing that business is working. So that's why you would separate those things out. All right. So here, this is a pretty decent time to talk about the concept of pro forma financials. So pro forma is basically a hypothetical situation. This is what may occur. Most people that are pre-revenue are generating pro forma financials. So sometimes in larger companies, you might have a project under consideration, and so they'll do pro forma financials internally to say, hey, we should make the investment in this new product or service or whatever. So they're used for planning potential transactions. I listed loans first, but as we'll talk about later, pro formas are less used in loans and more used in looking at like raising investment and acquisitions. So and we'll get to those reasons why loans made by banks are going to look more at your historicals versus your potential, because they're so conservative, and there's reasons why they're conservative. But we need pro forma financials, especially as a young startup company, to raise money to potentially be acquired or acquire another company. So kind of the primary document you'd be looking at pro forma would be income statements and cash flow statements, which we haven't talked about yet, but we'll talk about. So the statement of retained earnings, this little document doesn't get as much discussion as balance sheets and P&Ls, but it's an important document. It documents some non-income statement activity, which we'll see. So as part of your annual closeout, part of the accounting process is this is where the statement of retained earnings comes into play, is because we're going to close out a year, profits and losses are going to be recorded, any distribution of profits that are made to the owners, this is where that all happens. So the retained earnings, I mentioned this before, it's the sum of all the company's undistributed profits over its entire existence. So this is kind of a cumulative element. So let's look at handout number 7. Now, I think I have slides on this too, because we stepped through it. So, okay, so you can follow along on the slides and on your example if you want. So let's say we have this ABC Construction Company. They're formed January 1st, 2013. So at the point of their formation, retained earnings obviously is 0. They've done nothing yet. So we get to the, so down here on statement of retained earnings, the first entry is we start off with 0. And then we get to the end of the year and there's net income of $50,000 and the owners decide to pay themselves $20,000 of that as a dividend. So we come down here and we enter them in the statement of retained earnings. The positive people who, I mean, you probably realize this, but I'll go ahead and point it out. In accounting, a negative number is the parentheses. I'm sure you all knew that, but I'm pointing it out. So we do the math, and so the retained earnings at this point is $30,000. So let's roll forward to the next year. So starting in 2014, I start with the retained earnings from 13, which was 30. I have net income of 70,000, and the owners decided, hey, we're going to pay ourselves $20,000 again. So we go down to record that. We start off with the 30 from the previous year, and then we enter the net income and then the dividend. And then we have a new retained earnings of $80,000. So it's pretty straightforward. One of the things to note is retained earnings are not necessarily cash, okay? Companies often take that money and invest it in, equipment, new hires, advertising, new product development. So this retained earnings isn't a reflection of, oh, we've got this cash on hand. It's just a reflection of, again, the accumulated net income that wasn't paid out. So here's a little picture of the function of the statement of retained earnings. It's a bridge, and it bridges the income statement with the balance sheet. So this is a really simplistic example, but it gets the point across. So net income comes into the bridge, and then dividend payments. Hey, this is an asterisk. Dividend payments are not an expense. They're not on the income statement. So they're a distribution of profits, and they're recorded here in the statement of retained earnings. So that's important to remember. And then the retained earnings is on the balance sheet. So little example here. We have a year and we generate $90,000 of net income. We come over here, let's say we began that year with 40,000 of retained earnings. Now we bring over the 90. We make a decision on dividends. We pay $50,000 dividend. Retained earnings at the end of that is 80. And then this flows over to the balance sheet where the owner's equity is impacted by the distribution of those retained earnings. So now we have total owner equity of 190 plus the liabilities of 20 is 210, and our balance sheet is in balance. So it's just a little bridging function that happens with the statement of retained earnings, sorry. And that's all written down in a handout for you for a little picture. Okay, so this is the next statement, or the next financial document is the cash flow statement. And there's probably nothing more important, especially for young growing companies or even shrinking companies, unfortunately, than the cash flow statement. It's basically reporting how cash is coming in and going out during a period. So again, the income statement's over a period, the cash flow statement's over a period, but they're different. They have different things on them. There's differences in timing. For example, a sales made in September, but paid for by the customer in October. So the income statement records the sale in September. The cash flow records the flow of cash in October. Also, cash flow includes some transaction types that are not on the income statement. A company loan will not show up on the income statement, but the loan will appear on the cash flow statement and also on the balance sheet. So there are some categories. There's 3 categories: cash flow from operating activities, cash flow from investment activities, and cash flow from financing activities. And these can be, the first one's pretty clear, but the 2 and 3, they can be confusing to people because they sound the same. And so one easy way to help distinguish this is the use of prepositions. So you might see cash flows of the company's operating activity, cash flow from investments made by the company, cash flow from financings in the company. So when you use those prepositions, figuring out what category something belongs in becomes easier. And we'll talk about these and it'll become more clear. So let's talk about some examples of cash flow from operating. You might sell something, so you get receipts from sales. You might pay suppliers, payments to employees, tax payments, interest payments to lenders. So remember, we talked about loans can behave differently. So here's an example. The interest on the loan is an operating activity. The principal payments are in financing activities. It's just separating out, kind of like the current and the current liabilities and long-term liabilities. There's loans behave differently on the cash flow statement as well. And then interest and dividends received from investments. Similarly, interest from investments is operating. The sale of an investment is an investment activity. So some examples of an investment activity would be the sales from, if you sold some stock that you purchased, purchase of an investment, you decided to buy some, maybe some CDs because you had an extra bunch of cash. You might sell a piece of equipment. You wanted to buy a newer piece of equipment, you sold a piece of older equipment. You might decide to buy a piece of equipment. So those are all, before I go too quickly, those are all investments by the company, as contrasted by financing in the company, which we usually think about is like we got some investors. They gave us money and we gave them stock. We paid some dividends to shareholders. We took out a loan and got a big chunk of cash with that loan. And then we made principal payments on a loan. Those are financing activities. So let's look at handout number 9. I think it's pretty straightforward. Go past 8 there. And so I guess this is just kind of showing you, the obvious things we just talked about: operating activities, investments by the company that bought it. Typically, it's going to be something like buying a piece of equipment, all that. Some companies you get into investing themselves, but typically you're going to see more like equipment purchases here and stuff. And then raising money, paying dividends, taking out loans, paying loan principals can be down here in financing. What you might look at generally here on cash flow is, obviously, did we have a positive or negative net? And then how did we get that positive, negative net? Again, is my operating activity a productive, positive thing? Is it negative, or am I having to borrow money just to stay in business? So this cash flow statement is key. Red flag activity, yellow flag activity. Hey, where are things working and where are things not working? I'm going to pause here and see if John wants to jump on this cash flow statement and say anything about cash flow. You don't have to, John, but I thought it might be something you might want to speak to.
Well, I actually love the presentation, Dennis. The only thing that I would point out is if you don't walk away, if you can only walk away from this discussion with one thing, cash is
Key.
the one you want to walk away with.
Yeah. Yeah. if you can manage your cash productively, you can make up for some things you're not doing productively. So we can tune those things. In fact, you'd be more attractive to somebody that would come along and help you tune some of those other things up. But if you don't have cash, it's hard to stay alive.
Well, one of the very early lessons that I learned, and I'm glad I learned it without experiencing it in my own company, is that there are profitable companies that go bankrupt because they can't float the cash.
Especially low margin, high volume business, right? Yeah. So, okay. Thank you, John. Okay. So, financial ratios, we're going to touch on these pretty lightly, talk about a couple of them, but they're going to be, in that book, it covers them in more depth. So what financial ratios are used to perform analysis on the health of a company, and they take from different elements of the financial statements, assets, liabilities, shareholder equity, debt, inventory, things like that. They're covered in detail on pages 33 to 43 in the book, but I do want to talk about a few that small business owners should be prepared to understand. Primarily regarding debt is something called debt service coverage ratio. There's some common leverage ratios, and then the concept of loan to value. Again, it's something that's going to be part of commercial borrowing. So the debt service to coverage ratio, I deal with this all the time when I'm writing up potential loan opportunities, et cetera. So it's just a measurement of what's the cash available to service the debt, the current debt obligations, or maybe the current and prospective debt obligations. So it's just how a lender might assess a borrower's ability to service a loan that they want to take out. So if you have a coverage ratio of less than 1, that's negative cash flow, and so that's bad, and you're probably not going to get a loan. But it gets back to what John and I talked about before, cash flow being king. So typically lenders will have these minimum guidelines for different, and it'd be just on what kind of category of loan. There'll be some sort of guideline in the bank or other lenders institution of what minimum ratios are required. So you basically have net operating income divided by the total debt service. It's pretty straightforward calculation. And so let's go through a simple one. It's handout number 10, but I also have the slides here. So let's just do this little example. The volunteer plumbing company is looking at a $30,000 loan to purchase and outfit a new truck. So the lender will calculate a debt service coverage ratio to determine volunteer's ability to pay off the loan. So volunteer provides some historical and pro forma financial statements that indicate net operating income will be $21,000 per year over the next 3 years. The lender notes that the debt service will be $7,000 per year. So Marwan, let's do that together. The debt service can be calculated as a net operating income divided by the debt service. So what do you think the numbers plug in as on this calculation? Marwan may have had to go answer an important call, so I won't put him on the spot if he doesn't pop in real quick. Okay, so I'll do it. So Winnie wants to do it.
I was gonna give the answer, but yeah.
I'm sorry, Winnie. I'll give you the prize anyway. They'll be in the mail. So you just take the net income divided by the debt service, and you get 3.0. That little X, that's some terminology or nomenclature rather that's used in lending. X is the burden, right? 3x, 1.5x, and so that's kind of what's going on there. So that means that in theory, volunteer plumbing could service the debt 3 times over, which would be very encouraging, and they would likely be able to get a loan with that kind of, given other things are fine. So some common leverage ratios, they They can be taken off balance sheets, income statements, cash flow statements, and there's a bunch of them. Debt, how much debt do you have compared to how much assets do you have? How much debt do you have compared to how much equity you have? And so before I go too far, so, I mean, it's natural for you to sit there and go, well, what's good and what's bad? And that's going to depend upon the industry you're in, the maturity of your company. So that's why for an introductory class, I just want you just to know about these ratios. As your company matures, they'll become more important. As investors start looking at you, it'll become more important to get deeper knowledge of that stuff. I wanted to introduce you to the ideas. So related to debt service coverage ratio and borrowing is the concept of loan to value, or LTV. And it's a measure of the relationship between the amount of a loan compared to the value. And often it's commercial real estate. You'll see this loan to value if you're buying a building or a piece of property or whatever, but it can be on a piece of equipment as well. Or in some cases, you might be putting up some collateral, something you already own, because you need money for cash flow. And so the loan to value is really based upon the piece of collateral you're offering as security. So again, it's just used to measure an amount of risk that the lender is making, often, again, on a mortgage. But it's a key component, and lenders will have guidelines internally on minimum or maximum loan to value rates, and that's going to be dependent upon industry again. But it's basically just the amount of the loan divided by the appraised value of the collateral at hand. So it's pretty straightforward. Like in real estate, commercial real estate, a typical loan to value, they might go, 75% of the value they'll give a loan on, sometimes 80, depending on things. Sometimes if it's a riskier thing, they'll only want to go 60, 65 if there's some inherent large risk activities in there. So it's just going to depend upon the circumstances, what a particular LTV the bank or the lender would be willing to do. Okay, so generally accepted accounting principles, or GAAP. And so GAAP, you've probably heard of GAAP, but it's just basically the name for these rules that were set in place to prepare these financial statements. And the reason why you want this is you want to make sure, if you're comparing two companies, they're using the same rules to form their documents. If they were using different rules to form documents, you couldn't really compare them. So publicly traded companies are legally required to use GAAP because of its prevalence in accounting. Most companies try to use GAAP because as soon as they start trying to raise money or borrow money, it's going to be required. So the single most important aspect, now, so kind of like John said, if you get nothing else, cash flow statement. So in GAAP, the single most important aspect is this concept of double entry accounting, okay? And so before we talk about that, this is a little encouragement to everybody here. And you've probably heard of these statements, fixed mindsets and growth mindsets, but this is my little commercial for being someone with a growth mindset. I think everyone on this call is. We'll just go through this. So, a fixed mindset believes talent is fixed. Growth mindset believes that talent can be developed. Fixed mindset believes that efforts, because you've got it or you don't, why try? Growth mindset is effort is the path to mastery. Fixed mindset people believes they are defined by their failure. They want to hide their flaws, whereas growth mindset people think mistakes are part of learning. Therefore, fixed mindset people avoid a challenge. Growth mindset people, hey, that's an opportunity. Failures are temporary. Fixed mindset people don't like feedback. They take it personally. Growth mindset people embrace it. So we're shifting our minds right now, all that, the buildup for double entry accounting, because it's where accounting gets confusing. And if you just follow what I call the rules and tools of accounting, you'll be fine. And this book was the first time accounting made sense to me. And so it was explaining this concept of double entry accounting. So most people, you guys are all too young to remember a checkbook that had a log in the back of it where you wrote down when you wrote checks and stuff. Most people are used to single entry accounting, where one transaction, I bought something, I wrote a check for it, I write what I wrote check down in a hard copy paper or online in my electronic transactions. Double entry accounting, every transaction gets two entries, a debit and a credit. So this is a big difference. So those two things together form something called a journal entry. And that is the basis of all your financial statements. Journal entries, we'll talk about it at the end, are made in the general ledger, which is the most important document because all your transactions get entered in the general ledger as a journal entry. So the reason why there's two, remember we started this presentation off with a basic counting equation. So I have to have two entries to keep this equation in balance. If I only entered a single transaction, the equation would immediately become imbalanced. So, example, big orange stump removal uses $40,000 cash to purchase a piece of equipment. The journal entry, which consists of two things, will do two things. It'll decrease cash. I spent $40,000 of cash, and it's going to increase equipment because I bought a piece of equipment. So I get the accounting equation here, and I spent $40,000 of my asset that was cash, and I got a new asset that was $40,000. So the two entries are made, and that equation is in balance. So what if they didn't have the cash to buy the piece of equipment? So let's look at it in another way. So we borrow $40,000 piece of equipment. Now, sidebar, I just got through talking about loan to value. They may or may not be able to borrow all 40,000, but let's pretend a lot of equipment companies will offer 100% financing. We'll assume they can. So they borrow 40,000 and they go to make the journal entry. One that's going to increase liability because now they have a loan, which is a liability, and increase equipment. So we come over to the equation. We add 40,000 in assets, 40,000 in liabilities. We can see now that equation balances, but it's confusing because I told you a journal entry had to be a debit and a credit, but they both have increased. And this is where it gets confusing in accounting. So what are debits and credits? So these are terms used to describe each half of the transaction. Typically, a person with a bank account thinks debit means decrease, credit means increase, but that's not necessarily true. A debit or credit is going to increase it or decrease it depending upon the type of account it is. And there's not that many, so it doesn't have to be that confusing. But this reminds me, I'll tell you a story in a second. So we have to keep this equation in balance. And so we have different account types. For the asset account type, a debit does an increase, which is counterintuitive, and a credit does a decrease. That's just the rule. And so we apply the rule appropriately, we'll be okay. And then on the other side of the accounting equation, the liabilities and equity, the debit behaves kind of like we expect. A debit decreases and a credit increases. So this right here reminds me of the story of my wife homeschooled all three of our kids all the way into college, except for mathematics. And so my oldest daughter was doing math using a program, and halfway through the year, we discovered she wasn't learning math. She was like cheating the system. So dad got to come in as the reliever. And so we started over for the school year, and she had two notebooks. One was called rules and tools, and one was called, homework or notes, or whatever, did her homework. So every time she was learning about a new math, it was algebra, she wrote this rule and tool down. Hey, these are the rules, these are the tools, this is how you solve problems. So she had that at her disposal. So account types and debits and credits, this little chart is just a rule and tool. If you follow it, it becomes easy on how to make the journal entry. So let's look at handout number 11. I've got slides here to walk us through it. So this is going to be probably the hardest quiz time. So put your attention hats on. So I'm going to put the rules up there for you so you can reference them. So a big orange stump removal uses $40,000 cash to buy a piece of equipment. Same example as we used before. So cash, I left a blank here. Cash will decrease by 40 and equipment will increase by 40. So the first thing I need to do is identify the account type. Cash is an asset account. Equipment is an asset account. So cash will receive. So now if I go up to the thing, I know cash needs to decrease by 40. So if I go up to this rule up here, figure out I need to decrease an asset. I come over, I see, oh, that's a credit. So I know that cash will receive a $40,000 credit. I know equipment needs to increase. It's an asset. I go up here and assets are increased with debits. So that's how I determine what's the activity. And so what's the actual journal entry look like? You may not have to ever do this, but you may have to go over it with your accountant. So it may be helpful for you to see this. This is how it's written in the journal. Debit, DR is the abbreviation for debit, CR for credit. So, and the format is debits are listed first and they're indented left, credits are second, indented right. So that's how this entry is made in a journal. And that little entry format can help you remember a kind of a memory aid. Debits are left and credits are right. Debits increase the left-hand side of the accounting equation. They increase assets. Credits increase the right side of the accounting equation, which are both liability and owner's equity. So it's a little memory aid, and then how they're entered is the same thing. So debits left, credits right helps you remember for these account types how that goes. I'll pause real briefly in case there's confusion or questions about that. I think it's straightforward, but I'll just give a second. Okay. All right. So let's do the example of when they borrowed the money instead of had the cash. So they take out a loan and they buy the piece of equipment. So now I have a new thing, notes payable, and it's a liability account. It's going to increase by 40. And equipment, we talked about it before, it's an asset account, it'll increase. So notes payable, if it's a liability account and it needs to increase, I go to my rule and I see, oh, that's going to be a credit. And equipment, as we talked about before, it's going to increase with a debit because it's an asset on the left side of the equation. So then how do I do my entry? I do the debits first, indented left, credits second, indented to the right. So pretty straightforward if you just follow the rules. Now, those aren't the only, going back, assets, liabilities, owner equity are not the only account types. Those are the account types on a balance sheet, but the income statement has account types too, revenue and expense accounts. So how do debits and credits, what are the rules and tools for them? So I'm repeating the ones for our balance sheet. And then now I'm going to bring in the ones for the income statement. So revenue, and this is just kind of the rule. It's decreased by debit and it's increased by credit. Expenses are increased with debit. So that's again the rule and the tool. So handout number 12 is, and I've got slides again so we can go with this together. Darla's Dresses writes a check for $4,500 to pay rent. we need to decrease cash by 4,500 and increase rent by 4,500. So, Winnie, since I left you out before, what we want to do, Winnie, is we want to identify the account types and the action that's needed, and we want to create the journal entry. So,
Yeah.
rent expense, what kind of account do you think rent expense is? Of the account,
Is a liability.
it's actually an expense account, okay?
Oh, yeah, sorry. Yeah,
No worries. It's a trick question. Rent expense was an expense type. So we're going to increase that by 40. And so we're going to create the debit. So how I know that is if I go up here to the expense accounts, I know I need to increase it. I say, oh, that's going to be a debit, correct? So what do you think cash is? What kind of account is cash? Of the account types up there on the left, what is cash an asset, a liability, revenue, expense?
So it decreased. So it would be a
So just what kind of account is asset? Is it what kind of account type is cash? Is it an asset?
I would say it is an equity, right?
Well, no, it's an asset.
Oh,
Okay.
it's asset. Okay.
That's probably one of the earlier charts we talked about in the beginning of the presentation. I've had the benefit of going through this presentation several times. So cash is in that asset account. So we know we need to decrease that asset account. What are we going to use, a debit or a credit to do that?
It's a credit.
That's a credit. That's correct. So that's how that is entered. So now we're back to the consultant. And so Connie is a consultant. She makes a sale for 10,000, which is paid to her in cash. So we need to increase cash and increase sales by 10,000. So we're going to go through the process. What are the account types? What actions needed? And then what's the entry look like? So cash needs to be cash is increased by 10,000 because she made a sale. What kind of account type is cash? Anna, are you with us? Okay, how about Will?
Sorry, slowly hit unmute. Cash is an asset.
So assets. So if I need to increase it, what kind of transaction? What kind of, is that debit or is that a credit?
It's a debit.
That's a debit. It's an asset account, so we create a debit. All right, Will, sales. What
It's
kind
a
of
revenue.
Good
And
job.
an increase, so it's a credit.
Good job. Okay, so you can see here, and this is all there is. These are all the account types right here, and this is the behavior. Again, you're not an accountant. You're probably not going to enter these, but you might get into a discussion with your accountant about what account type something really is, or the accountant might start using debit and credit, and you need to at least be aware that they behave differently, and you might have to remind yourself, have a cheat sheet to have the conversation. So. Okay, so we're done with the mind bend stuff. So the general ledger, as I kind of referred to this before, this is where all those journal entries actually get recorded. In the old days, there was a big old book, big paper documents that those were entered into. Now you have things like QuickBooks and Sage and Oracle. It's the most important financial document because it's where things get recorded to produce every other document. Will, you're still, mic's still open, just to let you know. So that's just all I'm going to say about the general ledger. Now we're shifting gears and talking about the concept of cash basis versus accrual basis. You know, most individuals or a lot of small businesses do cash accounting. They record a sale when they get the cash. They record an expense when they spend cash. The problem is with cash accounting, it doesn't always reflect the economic reality. An example of that would be if I make quarterly or annual payments on expenses. If I pay, quarterly for subscriptions, if I pay annually for some reason for anything, then if I pay for something annually and I just do it in 1 month, it's going to distort the financial performance of that month, when really the right thing would be to spread that out. So cash accounting is not that accurate for determining what's really going on. So GAAP requires accrual, and that's where we spread expenses more appropriately to reflect reality. So because you record a sale when it's made, you may not be paid right away. That's why you have an accounts receivable. The same thing is you record the expense when you sign the purchase order or whatever, but you may not pay for it right away, and that's why you have an accounts payable account. So accrual accounting is what creates these accounts receivables, accounts payables. And that's why you need both an income statement and a cash flow statement to kind of see what's really going on with a company. It can be difficult if you just have one. So the goal of the accrual method is to fix the major problem with cash method, and that's the distortion of the reality due to, payments that are made for a large period of time.
Ennis,
Yes, sir.
on that cash versus accrual, one of the benefits I found in accrual-based tracking is you can count your receivables, the bills that you send your customers, as income before they actually pay that invoice.
Right.
So when it comes to reporting to the bank, now the bank's smart enough, you're not going to pull the wool over anybody's eyes because you're going to age your receivables, but you get to count them as income 60 or 80 or 90 days before you actually collect on them.
Right. Good point, John. And that, I'll just touch on this right now because it's easier to talk about it as you mentioned that. In fact, I talked about this with Anna about, an SBIR grant is kind of a receivable.
Right.
And if you have inventory you sold that you have receivables on, there are specialty lenders who will lend on receivables. It's called factoring and stuff like that. We'll talk about it a little bit more when we talk about the commercial borrowing, but you're right. It's an asset now that can be leveraged. So good point.
So the flip side of that then is, why is cash reporting beneficial to the company? And you probably have the full answer, but my short answer is for tax reasons. Because you don't want to have to pay income tax on receivables that you haven't collected yet.
That's a great point. I wasn't going to say that, but that's a great point.
So what we used to do is report on a monthly basis based on accrual, and we were on a calendar fiscal year. So on 12/31 every year, we, for an accounting reason, would convert everything to cash, report that for tax purposes, and then continue on an accrual basis for reporting.
Okay. Good point. Good point. Okay, so we talked about the concept of the accounting close process earlier when we talked about the statement of retained earnings, etc. But it's just basically, it separates revenue and expenses over a period. Typically, we close out on an annual basis. It makes more clear when you're managing operations within a year, within the quarters and months. If you had continuous accounting, it would become very difficult to make managing operational decisions. And it's the process for getting net income into retained earnings and making distributions. So that's just the closeout period. So we're kind of hitting some topics on one-sliders now. The concept, this is something that didn't make sense to me till I read this book, depreciation, amortization, because I think of amortization regarding to loans, but This is a different context for the word amortization. So depreciation is both of these words, these functions are taking an asset and they're expensing it out over its useful life. And we do that for a fixed asset. We use depreciation, a fixed asset being a building, a piece of equipment, something, hard, tangible thing. And that's where we use depreciate. We depreciate that. And again, there's schedules for this depending upon what kind of equipment it is. And I might do a 5-year depreciation. I might do a 20-year depreciation. That's a decision for you and your accountant to look at both guidelines, and there's some flexibility in there to choose, but that's a strategic decision to be made by you and your accountant. But you also can expense intangible stuff, but you don't do it with depreciation, you do it with amortization. And it's things like organizational costs, copyrights, getting patents, those kinds of things. You can take those expenses, most of them being like legal expenses and stuff, and spread them out. Again, there's guidelines for that, but that's just a different context for that word amortization than the rate of a loan amortizing. All right, getting closer to the finish line here. Inventory and cost of goods sold. GAAP, according to GAAP, there's 2 primary methods for tracking inventory. One is called the perpetual method, and it's real-time, barcoded, point of sale. In real time, you know exactly what inventory you have. And that's really great because it's really accurate. Your financial statements reflect accuracy. The downside is it's expensive, so a lot of people can't afford to implement it. The other method is periodic, where you take inventories on a regular interval, whether that's quarterly, semi-annually, annually. And the inventory is accurate at the beginning of the period, at the end of the period, but it's not really accurate in the middle. So because it's not an item by item thing, you have to make some assumptions when you're doing your cost of goods calculated. We're not going to get into that, but I'm raising it as your business becomes real and mature. These are details that'll come up. Some of the ways to do how you do the kind of cost of goods sold is the first in, first out. Because when you bought your inventory, the cost may change over time. So you may choose to use the oldest items and their cost first. You might choose to use the last ones in first. And there's different reasons why you might do that. Again, that's a conversation for you and your accountant. But just be aware there's different methods for that. You could average them. So again, all this is in this book called Accounting Made Simple. It's inexpensive. I have copies. If you want to come see me, I'll give you a copy. If we would have met in person, I would have given you a copy, but we couldn't. So I mourn the meeting in person. I'm an in-person kind of guy, so I hope I didn't talk too fast on this stuff. I'm reminding you that there's deeper talks about financing your stuff on our website. You can watch these videos. You can watch the whole thing at once, or you can watch them in chunks. Hopefully you find that useful. Also, just for those of you who high level, what Three Roots primary products are is we do commercial lending. I run this rural microloan program. So if your company happens to be in a rural census tract, which none of yours are probably if you're at the Spark, but if you know someone who is, then, and they have a small loan need, that's something we do. And then we do larger loans focused on small business, commercial real estate. We basically focus on job creation, placemaking type, and community kind of community facilities in our lending. So yeah, majority of our activity at Three Roots is not startup company related. We're big believers in the startup area, and as we develop more financial tools, that's part of the investment area that we're going to grow our focus. But right now, our primary tools are commercial lending tools for established companies typically. So that's the end of the accounting intro. I'm going to pause for 5 seconds in case there's any questions before I start a different presentation. In case I have to.
Dennis, one point that I would make is when you get into kind of the details of the discussion that you just presented, for example, how you account for your inventory, whether it's
Right.
FIFO or LIFO or average or whatever, how you might want to particularly pay tax.
Right.
What's important to know is that as an early stage company, what you do today is going to be very difficult to undo in later years. So if you want to change your accounting practice out in year 5, the IRS may give you a hard time about that. And in fact may come back with corrections on old taxes or something awful. So it really is important to understand as you begin these processes to understand what those principles are so that not only do they make sense today, but as we like to say, think 2 or 3 or 4 moves out. Try and look around corners and make sure that you're not building a trap for yourself.
That's a great point. Really great point. Because changing accounting systems is a pain. All right, let me pull up, hopefully this all goes well. I'll pull up this borrowing overview. Okay. And it said my screen sharing stopped. Let me go back here, share this screen. Okay. All my screens jumped everywhere. All right, so, and this is shorter and a more fairly high level. I guess I can probably maximize this because there's no other reference slides. Okay, so commercial borrowing, kind of an overview of some of the things that are important to know about. Again, I talked about these resources, video resources. We talk about the sources of capital as well as debt as a source of capital where we're interviewing some bankers and stuff. So that would definitely be worth your watch. So this is kind of interesting. I started at Three Roots in 2017. And I was a technical guy. I wasn't a finance guy. And so I've had to learn a lot of this stuff in the last few years. And so one of the things I've noticed is there's some real misconceptions around borrowing commercially because average bear on the street, as I like to say, is their expectations, their experiences around, credit are shaped largely by these areas: car loans, home loans, credit cards, and student loans. And those loans are all easy to obtain. I mean, when I was in college, I was getting stuff in the mail almost every day about credit cards and stuff. And part of the reason is, with cars and homes, collateral's built in. There's a lower risk of default on home loans and car loans because people need them to get to work and to live. College graduates for student loans typically are lower credit risks. So there's a reason why these types of loans are easier to get. And unfortunately, until you have to obtain a business loan, you just assume business lending is the same, and it's just not. And there's some reasons for that. Banks, who are the primary commercial lenders, their credit policies, they vary greatly, significantly from consumer lending, and there's reasons for that. I probably should have reversed the order of these. The first thing is margins for a bank are very thin. They can't, if you just do the math, if you borrow $1 million at 3% interest, but the loan goes bad, you got to make a lot of $1 million loans to make up for that loss of $1 million in principal. 3% is not much. And that's their gross margin before they take out their expenses. So first of all, margins on lending are thin. So defaults are painful financially. The other thing is that banks are heavy, and it's gotten worse since the financial crisis. Banks are heavily regulated. And unfortunately, the regulator who visits a bank on an annual basis, there's a lot of unfortunate room for judgment by that regulator. And the regulator has the power to remove the bank's ability to lend and to borrow themselves. So because the regulations and the regulators have become way more tight, therefore banks' loan underwriting practices have become more conservative. And so it's more difficult to get a commercial loan. So there's something called the 5 C's of credit. We're just going to go through them, and it helps shape some of the aspects around borrowing. So the first thing is character. What's the credit history of the company or the individual? What kind of track record or reputation do they have? If it's an individual, or if there's always going to be, almost always going to be a guarantor, what's the credit score of that guarantor? Do they have any outstanding liens? And here's a really important point, because I had a company I was trying to help 2 years ago. Really nice person, pretty good company, but in prior years, the company went through a real cash crunch. No surprise, John. And so one of the first things they stopped paying was their payroll taxes. And that's the last thing you don't want to pay, because those things, you can't get rid of those. You can't get rid of them through bankruptcies and all that. So the federal government will put a lien on you, and you will not get a loan with that lien in place. And so I think that's also true for student loans. So you do not want the federal government or anybody placing a lien on you from a previous credit thing, because it'll prevent you from getting a loan in the future. So a second C is capacity, and that's basically, and this is kind of historical. Have I demonstrated historically that I have the capacity to repay this debt service that we talked about earlier with that ratio? Then what's the debt to income ratio? What's the maturity of the company? The third C is capital, and that is, hey, what kind of capital is this borrower bringing into the project? Do they want me to finance it all, or are they willing to put some of their own equity into the project? The greater that percentage is, the lower the risk. And then that also impacts the rates, the terms, and the guarantor requirements. Sometimes you can eventually remove guarantor requirements if that loan to value percentage is low enough. So if you have enough equity in the deal, you can get relief on some of the guarantor requirements. And then there's collateral. That's basically there's something of value that I can pledge against this loan. I'm securing this loan with this thing of value. And unfortunately, in the case of the loan going bad, the creditor could then take that asset, they could liquidate it and retain or recover some of the principal they lost. So the quality and amount of the collateral will impact, again, it impacts risk, therefore it impacts the rate, the term, and the guarantor requirements. And then there's just the surrounding conditions. How much is the loan? What's the market rate, or what's the potential rate for the interest rate and the length of the loan, the term? And what's it being used for? Is this commercial real estate? Is it equipment? Or there's some built-in collateral? Is it just working capital? Working capital for a software company. Well, I got no assets here. What am I going to do? How am I going to borrow money? So what industry is it in? They'll have different guidelines depending upon the industry that the company's operating in. And then this concept of personal guarantees. And a lot of people are shocked by them when they first hear about them, but they're required most of the time. And you'd be surprised how long they're required. There was a company here in town that we had an equity investment in that had a really big exit not long ago. And the CEO of that company was a guarantor when that company was well mature. And it was only in the last 6 to 12 months of its before it sold that CEO could be released from guarantee. So it's just a fact of commercial borrowing. And then the strong position of a guarantor, it lowers the risk of the loss of capital. And here's something that some startup companies can it's a tool. Not everybody uses it, and it's probably not even used frequently, but it can be used. There was a high net worth individual some years ago in the Chattanooga area that did quite a bit of this, where you could have a third party person that's of high net worth, and they can serve as the guarantor on your loan on behalf of the borrower. And so, they don't typically do that for free. They're compensated for that service, and so they're paid a fee. They're given equity, sometimes both. And so this is a tool that immature companies with no track record can use to potentially get commercial loans. And then Chris and I were talking about this, and he brought this up. It's a great distinction. There's an underwriting process, that word, and there's a process called due diligence. And they sound similar. They're kind of similar, but they're different. Lenders typically perform underwriting, and they're focusing on the ability to repay. Protection of the principal is their primary motivation, and they're going to focus on historical financials more heavily than over pro forma, although pro forma will be looked at as well, especially when construction and stuff like that would be involved. And they're going to look at cash flow, to ability to service debt. An equity investor is performing due diligence, and they're focusing on establishing, validating, finding, determining the upside. What's the return on the investment? And they're going to focus on the team's ability to execute on that plan, the market conditions. They're going to obviously focus more on pro forma because they're looking at the future and the potential. Now, depending upon the maturity company, the historicals are going to be very important as well, but they're going to place a lot of value on pro forma. And they also, everybody's interested in cash flow, but especially that investor wants to know that you can either cross the chasm completely, or at least you're going to have enough cash to get to the next series. You've de-risked the investment far enough. You've made enough progress for the next series of investment would be likely. So that's kind of distinguishing between underwriting and due diligence. And that might be really helpful for you guys, because you probably focus a lot on due diligence and trying to attract equity investors. But at the same time, if you're thinking about getting a commercial loan for some cash flow, realize the kind of similarities and the differences between the two. I think, yeah, that's all I have on that. So I'm gonna leave these slides up in case there's questions about that for a second or two, and then we can talk about indirects.
So Dennis, as an early stage company starts to experience some of the pain of cash flow, that cash flow, really, I mean, unless you have a great big investor or you have a lot of cash from family and friends and yourself, your early stage company is very, very likely to experience some cash flow pain. When I'm an early stage company and I go sit down and talk with the bank and I present my pro forma financials, including my cash flow statement, what kind of, and I understand the questions that they're going to ask, like all of the leveraging discussion there, or the ratio discussion that you had in this list of underwriting points, which are great set of points. What kinds of accounts, what kinds of lending instruments will banks be able to offer? So for example, when I was doing it, we set up a thing called a revolver, or a revolving line of credit.
Right.
What sorts of programs or tools do banks use, and how should I think about what the bank is going to ask for that, including what it's going to cost me?
Right. Yeah. Before I answer that, this would be a good reason why to watch some of those other videos. We get a little more in depth with some of the bankers online and stuff, and a cost of capital video as well. But yeah, so some of the different instruments available, like John mentioned, a revolving line of credit. What a revolving line of credit is is, hey, the bank has approved my company for a $250,000 line of credit. So they went through an underwriting process with me that said, okay, Dennis, your company has this line of credit available to you. You can use that money at your need, and you pull it down. They may have a process for that. They may have limitations on how many times per quarter, per month you can do that. So it's a great tool for companies that have, especially companies that have product sales, and there's a lag between sales and payment. That kind of tool is going to be available mainly to an established company that has a historical track record of revenue, sales, like we talked about for the aging on how fast you get your accounts receivables paid. They'll look at the aging of those receivables and say, hey, okay, this company is operating, it's a going concern, and it could support this much. Sometimes the amount of that revolving line of credit might be tied to the amount of your inventory and stuff like that. And they may have some specific triggers like, hey, we will finance. Let's talk about it in terms of maybe not so much a line of credit, but you might get financing on your accounts receivable. It may be like a line of credit, but it's more like on your accounts receivable. Hey, you constantly have an outstanding accounts receivable of $200,000. We'll finance 70% of that. We'll give you that up front because you have a track record of getting payment on that. And so it's lower risk. And so we'll let you pull down on that. Now, those kinds of loans might have either a little bit higher rate or have some fees established with them, which are reasonable because the bank has to spend ongoing energy monitoring your inventory and interacting with you on a regular basis to get accurate inventory reports or accounts receivable reports and aging reports. But those are tools that once you do, one thing that creates cash flow problems is the fact that you're making sales and you're not getting payment as fast. So that's good. And once you can get that going long enough, then a bank can see that as a risk that they could manage. But it probably isn't a startup tool. There may be some exceptions to that, and I explored that with one of y'all Sparks teammates where, hey, these SBIR grants, they're kind of like an accounts receivable. And so I did quite a bit of interacting with our bank partners, and none of our traditional bank partners had appetite for that. But there are one of the companies that we have worked with through referral, giving them some referrals, is a factoring company, and company called JD Factors in town. And what factoring companies do, and this is talked about in the debt as a source of capital video, but what factoring companies do, and they do this a lot, like trucking companies are real good examples of that. They have this recurring business, and so the factoring agent actually will take over the purchase, the accounts receivable, and they'll pay the company up front a percentage of it, and they charge a fee for that, and they actually collect the money, and then on behalf, sometimes the factoring company steps in the middle and sometimes they don't. But it's a tool when you have a hard accounts receivable that you can use to monetize it, and you're paying a fee for that. So if you have high margins, you don't give a darn, right? Because what's 8%, 9%, whatever it is, when you need cash and you have plenty of margin in your product, you might build that in your financial modeling. So revolving lines of credits, factoring, those are kind of operating focused loans, right? The commercial construction or buying real estate, that's kind of a whole nother category of, you got this building you want to buy. It's kind of like similar to buying a house. So can the business afford the house payments? Does it have some cash to put in? If it's an owner, there's a distinction to banks. An owner occupied piece of real estate is lower risk to the bank than a speculative, like I'm building a strip mall and I'm trying to get tenants. So the bank would give an owner occupied owner probably maybe a little bit better rate or better term, or maybe lower equity requirement because they're operating in that entity. So that's a distinction that's worth noting. So I don't know if is that done that touch on that for you?
Yes,
Anything?
absolutely. I want to add a couple of other thoughts. One is that cash, especially cash that you borrow, think about it as any other kind of an asset. You as the CEO, your job is to put that to work and to actually create value
Mhm.
through earnings from putting that cash to work. That's kind of very big picture commentary. Sub to that is the idea of commercial debt, and I'll make this point by way of example. Commercial debt has lots of different aspects, lots of different details, and Dennis, your list here is a great list of those details. But one of the details is when do you, as the small business, need to actually take the cash? Because once you take the cash, you have to start paying interest on it. So the example is a company that I'm working with here in Knoxville that has a construction project, $500,000 construction project. And when we were negotiating with the bank wanted to hand the $500,000 over to the company on day one. So there was going to be a $500,000 sitting in our account in cash that we couldn't really put to work until construction began, and we needed to start to pay the construction contractor and the material suppliers and all those kinds of payables. So we needed to negotiate the kind of relationship, the kind of day-to-day sort of transaction that you described, Dennis, where you take that loan down in pieces, whether it's predetermined based on progress on the job or based on time. Maybe you're going to take a quarter of it down a month for the next 4 months, some kind of thing, some kind of schedule and process that makes sense to both. So again, be careful of the details and make sure you understand the principles.
Yeah, that's a great point on that. And in John, in your case, because it was probably by construction standards a smaller loan, that they wanted to give it to you up front. A lot of times in a lot of projects we do, are larger construction projects, there'll be draws. There'll be so it'll be a schedule or a reimbursement type thing, and luckily the borrower doesn't have to pay until those draws actually happen. And before they can even draw any of that money, they have to use the equity they were putting in first to pay the construction. They exhaust their equity first, and then they can draw down on the construction loan.
Right.
Yeah. So that's a great point of the timing of when you want to take the money. But you also reminded me of a really important point, John, and that is the importance of relationship. Don't wait until you need to borrow money to have a relationship with a banker. That's too late. They're going to want to see a history, but they would be nice to see a history, but also have a history with you. In fact, the specific person and that person can chime in if they want to anytime. One of you Spark peers solved the cash flow problem through a relationship with their bank because they had a relationship with the bank. And so that's something to consider earlier in the stage than you might think. You might try to figure out, what bank do I really want to be banking with? 2 years from now, when I'm qualified to borrow money and I need to borrow money, who do I want to be banking with? I might start looking now. Because if I just have a national bank partner, which sounds great because they're big and powerful, but they don't have a local branch, there's no one to know. But if I go to the credit union, who's my best friend, but then they don't do commercial lending of my type, you know? So you might want to think about those things earlier than you might have previously thought. So I wish I probably should have put that somewhere in that presentation.
So maybe open that relationship and actually borrow some money when you don't even really need it.
Yeah, that's that's one of the things I've done with my kids from the whole student loan perspective is instead of just getting a government guaranteed loan, help get them a actual loan from a real bank that they're responsible for. I may be helping with the payments, but they're establishing credit. Hey, I've borrowed money and I've paid it off. That's an important thing.
So I don't want to go so far as to suggest a sixth C, but when you were talking about the 5 C's, I was sure that one of those C's would be covenants.
Oh yeah, well, covenant is not so much part of the underwriting as is a covenant as part of the loan.
Correct. So
Yeah.
can you talk a little about what is a covenant or covenants?
Yeah, sure. So covenants, the word covenant is an agreement between two parties. I'll do this, you'll do that. And so there's kind of two types of covenants you'll see in loans. One would be financial covenants. In other words, for you to be not in default on this loan, and most people say, as long as I pay my loan payments, I'm not in default. Well, that's not necessarily true. You might have a financial covenant in your loan, which says my debt to service coverage ratio has to remain above 1.2x. That means my company operating success needs to be good enough to cover that loan by this amount. And if it drops below that, the bank could consider the loan in default. So yeah, that's a big deal, right? So you need to be aware of that. Now, banks don't like to default on loans because it's pain. So, but that's a financial covenant. You might have reporting covenants, and those are more requirements that you report, and you're going to have those in any loan. You might have to do your annual tax returns. You might be required, especially if you're a young company, at least quarterly financial documents report. I want to see your financials every quarter to see how you're doing. Your personal taxes, for the guarantors, the personal financial statements. We didn't talk about personal financial statements, but I'll go ahead and talk about that. As a guarantor, a person provides typically their tax returns to show their financial history, as well as something called a personal financial statement, PFS. And that's just, it's a formal listing of your assets and personal assets and liabilities. I own this much property, I have this much cash in the bank, cash in investments, cash in retirement accounts. And then the bank or the lender goes through a process of saying, how liquid is this guarantor? How good of a guarantor are they really? And so PFSs are part of how you determine that. And they can be quite complex because people have ownership in lots of companies. They get these things called K1s as part of the returns. And good guarantors have complex PFS statements, unfortunately, for me.
So one of the kind of high-level oxymoronic features of this world is when Dennis was describing covenants, and if you start to approach the failure of one of your covenants, and typically the consequence of failing a covenant is your bank loan gets called. And let me make sure you all understand, getting a bank loan called is a really, really bad thing. Okay, so what's fascinating to me, what makes this oxymoronic is when your covenant begins to move toward default, it means you're having trouble. It means that you need that bank loan more than ever, and the bank's going to turn its back on you and take it away. So all I'm saying is make sure that you're looking out far enough that you can ensure that all your covenants are going to be met, all your bank loans are secure, and let's get back to making product and making money. That's really, really critical.
It's a great point, John. I will say, specifically, last year's COVID situation is, our bank partners and therefore us, we had several of our borrowers who would have been technically in default, but we made special provisions to suspend payments, for either go to suspend payments entirely for a few months or go to interest only payments. So under the right circumstances, the bank will go in and modify the situation so that you don't technically fall into default. So again, but I think John's caution is very, very well stated, that you do not want to default on your own. And here's the deal. The reason why banks typically have those in place is, again, remember, commercial banking is typically done with mature companies, right? And so they're looking at the situation. They have the covenant in there not to default, not to foreclose, but to force the equity partners to do something to get the company, inject more capital in, do something to get this company back on pace. So it's kind of the threat of default causes some other equity holders who have the means to make this company do better to do so. That's the probably primary motive of having a financial covenant in there. So anyway, because the equity stakeholders have a lot more to gain and a lot more to lose than the banks, even though the bank they don't want to lose what they have at stake. It's typically, that's why this conversation, I'm glad we're having it, John, is the banks are in what's called a senior position to the equity holders. So if a company goes under, senior lenders are the first people who get paid. Okay. And then before the equity holders, there may be something called subordinated debt. We've actually done some subordinated debt as a lender. There's people who will come in and lend junior to the senior. So if things go bad, those guys get paid first. Now the subordinated debt gets a higher interest rate, a higher return, because the risk is higher, right? And then after those two get paid, the equity holders get paid, but the equity holders get paid a lot higher rate, the equity, right? So it's all kind of part of that risk reward, risk rate connection. You'll hear, again, some of those videos on the other videos cover that in more detail, but it's a good point to cover.
So I'll give you a personal story about our banking relationship. And our corporate banking relationship was with Fifth Third Bank. Fifth Third has some operations in Knoxville. Headquarters is in Cincinnati. And I worked with the corporate level guys, and they were tough. And it was worth it because of the lessons that they were able to give me personally. And one of the lessons was answering my question, why is it that I have to keep providing a personal guarantee? We have, we're churning through millions of dollars of revenue a month. It's a services business. So, our payables are 70 days. I'm going to need to have several $1 million that you guys are collateralized 100% or more. I got huge coverage on these loans. Why do I have to provide a personal guarantee? And just one of those simple personal comments with a wink, it was like, John, we just really want to make sure that your head's popping off the pillow every morning and you're thinking about us. And it's like, great. In one of my first interviews with Fifth Third Bank, they asked me if I was concerned about bankruptcy, and, watched my eyes when I said, why, no, bankruptcy is not a possibility for us. We're a successful business. And they again kind of smiled and winked and said, wrong answer. Bankruptcy needs to scare the living hell out of you, John. And they're right. So my only point is, as you start to grow and as you start to rely on others for funding, whether it's debt or whether it's equity, you have an obligation to make this enterprise work. So be careful, think several moves ahead, understand what the details are, and you'll be fine, right? So,
Okay,
Dennis, back to you. You want to talk a little about indirects?
sure. And this is more just a bullet list of stuff here. Let me get my screen sharing back on for you. Okay, let's see. Boom. Oh, I'm sorry. I opened up the same presentation. I apologize. Indirect rates for government. There we go. Oh, there's some chat questions. Oh, that's just Brandon saying yes. I'm not good about watching the chat box, so John, keep an eye on that for me.
I did. I saw them from Brandon, and we're good. So one of the things that I think that's interesting, and indirects satisfies this curiosity of mine, is I'm always looking for ways, especially to certainly comply and pay my taxes, but I want to find ways where I can use those big systems to my advantage. One of the ways, and Dennis touched on it, is depreciation and amortization. So depreciation is a way that the tax code allows you to subtract what you're investing in certain items and allows you to subtract those investments over some period of time. And it's important to understand what those rules are so that when you make investments, you'll know how that'll affect your income statement and balance sheet. Most importantly, your balance sheet. Indirect cost is the same thing. So your indirect rate that you charge the government helps you recover costs that you can't bill directly. So understanding what those systems are, what the line items that are allowable, and how you put them into a workbook that gives you a formula is really important to understand. So when the government says, hey, if you don't claim more than 10%, we won't need you to submit your indirect costs. My initial reaction is indirect costs will probably stack up to more than 10%. So be careful. And Dennis is equipped to give you more of the details and the true the rules and tools to understand how to navigate through the indirect space.
Hey, I apologize. For some reason, my PowerPoint, when I made the PowerPoints, I screwed them up somehow. So I don't have a PowerPoint. So I just have luckily I have a PDF of the notes I made to make the PowerPoint. And most of these notes come from Chris Miller, our CFO, who more directly deals with indirect. He's the one that negotiated our indirect rate both times we've done it. And so he was unable to join us. He wanted to be able to join us, but he's on travel today and just cannot. So I'm doing the best to relay. This is not a cookbook so much as a heads up. This is the lay of the land, and maybe, as John said, the reason why you might even bother fooling with it, because it's scary enough to say why fool with it. But John made the point. It's most indirect rates are going to be significantly higher than the 10%. You can use that if you like. So let's just go through these points again. I apologize for it being not very pretty. So indirect rates. So point number one, they're negotiated, not really, with what's called a cognizant federal agency. And it's actually happening more and more. Point number two is many agencies actually don't do this themselves. Like the agency you might have your grant with, they have a shared services agreement with the Department of Interior, who basically negotiates the indirect rates with the business owner on behalf of the other agency. So you actually may, as a business owner, you may be negotiating for your rates with an agency that's completely different than the agency issuing you a grant or a contract. Pretty common. It's happening more and more because they're bad at it. And so point number 3 is there's specific laws, federal laws called CFRs, and there's gap guidelines in place for calculating indirect rates. And in addition to those, the grant making agency may have additional requirements. There's kind of 2 general types. One is when indirect and fringe are all bundled together. And it's one category and it's a percentage. I'm sorry, that would be the second one, when they're bundled together. The first one is when they're separated out. You have a separate rate for your indirect and a separate rate for your fringe, and you're allowed to charge both. And having that complexity can be advantageous to you depending upon your particular grant or contract situation. When you go through this process, what happens is you're point number 6, you get what's called a provisional rate. And it says, hey, we assume this is your accurate rate. Go ahead and charge this way. However, there's a finalization at the year end where actual rates need to be at least what you were approved of or higher, or else you might run into a situation where you get into a recapture situation, which you do not want to be in, where you've overcharged the government. So it's important to be able to have your insight and control over what's going on with those rates. It may require that you have audited financials. And if you have to have audited, you may have to, in addition to standard auditing, there's a government GAAS, I forget what it stands for, but it's a federal set of additional requirements that when you get your annual audit done, they also do gas testing. It's not typically terribly much more expensive. Like if your audit is $10,000, $15,000, a gas addition might be $1,000 to $2,000 more for your audit. Big point here, number 8, always maintain a paper trail of your approval process and the supporting documents you have to support your rates. Because the people you deal with at the government entities are always changing spots. I mean, I had a small 3 routes, had a small grant from the Department of Ag at Tennessee State, and my point of contact over the 2-year project changed 5 times. So you want a paper trail to support the history of the stuff you agreed to. Number 9, the rates are applied to the direct billing activity. So a little example would be, let's assume I have a bundled together 25% rate. If I have $3,000 of labor cost, I actually get that plus the 25%, $3,750. Some grants have a match requirement, and not everybody's behaves the same, but most of the time it behaves kind of like this. So like assuming the conditions of number 9, if there was a 50% match requirement, the reimbursement would be half of that total amount. Okay, so and there's forms they have, SF 420 something, for filing for those, and you have to fill them out the right way. So having the actual rate approved and filling out the forms in the proper way is something you need to do correctly. And like John said, if you say, well, I don't want to go through all that hassle of negotiating a rate and getting approved, I'll just take the 10%. Well, depending upon the size of the grant or the contract, it can be a lot of money. Especially for some services companies. Like I know John's company and my former company, SEIC, our indirect and fringe rates were high.
Oh, yeah.
Yeah, I mean, like 40, 50%, and you put them together and you'll have a person over 100, maybe sometimes 200% billable, right? Now, something to note about that, when applying for competitive grants, to be competitive, you often will have to say in your proposal, hey, we've got an approved rate of 40% on fringe and 35% on indirect, but we're not going to ask you to, we're going to bid 25 and 20 or whatever to be more competitive. And so that can happen. It may be necessary. You may be given some guidance sometimes to be competitive, but you also have to watch out for those things. And I think John and I talked about this. I think it happened, John, it used to happen more than it happens now. But sometimes in government contracting, less so in grants, but more in government contracting, sometimes you might get hit with this whammy. The government contract says, hey, by the way, when you issue your proposal, you have to guarantee that you're charging us the lowest rate you've ever charged the federal government. And so you got to be careful about that as far what rate you choose to use, even once you've got one approved, because it can come back to kind of hurt you on setting a low point on your bar. Now, probably not real applicable to SBR, STTR grant situations, but just as we're talking about indirects in general, John and I wanted to kind of cover the waterfront of our experience with them. So John, you can jump on this list and add, or
Dennis, if you can, let's get Anna to chime in. She's in the chat box and has some recent experience to share.
Yeah, so I guess the context of my recent experience is we had a provisional indirect rate for our NSF SBIR Phase 1 award. And then I would say a lot of our cost structure has changed over the year, actually like putting a decent amount of people on payroll. And that all being said, when we applied to our DOE STTR Phase 1 and the Office of Fossil Carbon Utilization Project, I used, a similar rate in our budget proposal, and then had to do like a full-blown indirect rate proposal at, during award negotiations. So I worked with an accounting firm on that. I actually have recently in the last couple months redone our indirect rate proposal after realizing some errors, and Dennis is laughing because he's heard me share this story.
No, I feel for you. It's not laugh. I'm just like,
yeah,
I'm sorry.
no, you're good. But yeah, so I guess like just a few things I have learned recently. Generally speaking, and this is true in the terms and conditions of every federal award I have received so far, indirects can always be applied to direct costs. If you find yourself in a situation where you've overcharged and you didn't really spend all of it. So, you'll go through sort of at least for ours, we will go through like a year-end audit, so to speak, and have to turn in an incurred cost report. And if we have basically overcharged for indirects and have not had as many indirect costs, we can actually always reallocate those funds into direct categories. So it's not like use it or lose it, so to speak. I was under the impression, I think our accounting firm that I was working with previously scared me a little bit into thinking that I would have to like give that money back, and so it would just be totally wasted. And actually, in the terms and conditions of our awards, that is not the case at all. So it's always going to be in your favor to like overestimate your indirects at least a little bit. I mean, you want to be pretty close, but to overestimate at least a little bit, and then keep really, really good track so that you know what is going to be on that incurred cost report. And if you are projecting that you will overcharge, that you make a plan to use the excess in direct cost categories in the budget. The other thing I have found that is like very important, and this is what got me into a little bit of hot water recently, but it's really important, I realized, to make sure that the way that, right, so Dennis is this overview of indirects is really good, and explaining that there's a lot of different ways you can do this. There's a lot of, you can have a fringe rate and an indirect rate, or you can have one lump rate, or I think there's even other sort of combinations of those, of ways you can do that. I've seen Vandy does something where they have one rate applied to basically a fringe rate, and then another rate applied to other direct costs, and then they have like a specific low rate applied to materials. So it's like pretty across the board, but it's very important to make sure that at the end of the day, you just like look at like what is the total dollar amount that you're going to be able to capture with how the rate is applied to your budget, and make sure that that's actually enough year to year, thinking about cash flow. Because what I realized is that the way our accountants set up our indirect rate proposal was like one rate applied to all direct costs. And while that is nice for simplicity's sake, the reality was our budget, like for our $2.5 million award, was like $500,000 the first year, and then that basically like doubled in year 2 and 3 of the budget. And so when you're applying the same rate to just to like lump indirect, or just to lump like direct costs, the reality was we did not have enough indirects budgeted in the first year, and we had way too much budgeted in year 2 and 3. And so we were left in sort of worst case scenario of where, we didn't have enough indirects to cover our true indirect costs year 1, and we would have too many in year 2 and 3. And unfortunately, that's a really bad place to be in terms of actually covering your real costs. And for us, like our indirects don't change all that much year to year with the same number of people on payroll. That would change, as we increase people on payroll, but they didn't change a whole lot, with the same number of folks on payroll. So this is all a cautionary tale to say, save yourself the headache. I was extraordinarily fortunate with very kind and understanding program manager and contract officer who recognized this as Skynano's first big award, and we're really gracious to say, okay, we'll work with you, we'll change it, we'll help push the change through. But I don't think that is always the case. I mean, they could very easily have just said, no, sorry, your mistake, you're stuck with it.
So John, we jump on. There's 3 things that I thought of when Anna told her story. The first thing is, remember how I told you you want to know your accounting language, you want to be conversant enough to set your accounts up with your accountant in a way that's good for you, because accountants want to do what's good for them. So the accountant, it was simple for the accountant to put the indirects all together. It may not have been best, but the more Anna knows about her business and her grant and her T's and C's, she can work with her accountant to do what's best for the company, not what's easiest for the accountant. That applies to your general ledger, how you set up your stuff in your business in general. So that's a general comment on working with accountants. The other thing is that I pulled out of Anna's comments is it's the details are in the T's and C's of your contract. So you need to dive into them and understand them. And the other thing is that John and my experiences might have more history in contracting versus grants. And that's where in contracting, it can cost you even more money because you're stuck with the rate, you're getting less for every dollar billed and all that. So there's probably more latitude and more flexibility in some of the granting agencies. But as Anna pointed out, don't bet on it. Good for her that they were flexible and they were kind. But if you get into a situation down the road where you got a government contract that you won competitively, it may be a situation where you're stuck. So, John, did you have something else? I think you said you.
No, that's great. So when you're a very early stage startup and you're the founder and you get paid based on the availability of funding, and you can float around inside of your company without any hard and fast rules about who gets paid what, that's great. I mean, that's that's kind of an interesting life. But as you grow and the rules become more hard and fast, especially as you begin to hire people and they expect to be paid on time, and you begin to bring in bigger grants or you have bigger clients and you can bill them for labor or product that you're actually delivering, that's great. But you're going to start to pick up indirect costs sort of unconsciously. So, for example, when you bring somebody on, when you hire them and you say, you get 10 holidays a year and you get 2 weeks of vacation. Well, what happens to those salary costs that go to holidays or go to vacation? Because you're not going to bill those to your client. Your client's not going to pay you for your employee's vacation, right? How do you get paid for that? Well, that gets bundled into your indirect structure. And it's the same with holidays, where in today's world, back when I started my engineering company, health insurance wasn't that big of a deal. You know, you could offer health insurance to not only the employee, but the employee's whole family, and it wouldn't affect our indirects that much. Today, it's a big deal. So when you offer health insurance to your employees, you can think about your indirect rate just went up a couple ticks. So think about how you are able to collect all of these costs. So costs are just like matter, right? They're not created or destroyed. They just float around. And sometimes as you grow, you will get more than your share floating to you. And you're going to have to collect them and you're going to have to work them into what your business model is. And in government grant work and in government contracting, or really any kind of contracting, you have to be able to collect that. So, and I'll close with just one kind of technical thought. In the services industry, and Dennis, you may have seen it at SAIC, but and we worked with SAIC quite a bit. But in the services industry, we would talk about the roll up of direct and indirects as a wage multiplier. So our direct wage multiplier target was 3. So if we were paying a field technician $20 an hour, we'd bill him out at $60 an hour. And the difference between 20 and 60, that $40 direct wage, that multiplier is what covered indirects and profit, mostly indirects. So if you're not pressed with an indirect rate now, you likely will be soon, especially as you grow. So keep an eye on it because it's really important.
Yeah, John, as you were saying that really should, the thought I had was this: the pain in the butt that going through the indirect stuff that Anna's has gone through, that's going to serve her well. She's going to understand her business and her real costs and how they are. So even if she's not doing a government contract, she'll have a better understanding of her operating costs to really put something out there to a customer. And as she goes to negotiate price with a private customer, she's got way more accurate information to get a good price and to defend it if she has to. Because some of her early customers may push her on price and she may have to go, well, let's just go open book.
Right.
Let's go open book and guarantee, let's agree that I get a profit of some percentage and I'll go open book with you. And what going open book is, here are my operating costs. And then I get this much profit. And so it's that the customer gets to see that, you get to get a guaranteed profit margin. So there's value to be had for the pain in the bottom that Anna's going through. And so it's an opportunity as you get a grant is don't take the low road on the 10%, take the high road, take the hard work to understand your business so you know what your indirect really is.
Absolutely right. Totally agree. Any
This
more
was better than I thought it
questions?
would be.
Questions, comments, stories? Anna, your stories are great.
It was awesome.
So if you roll this out 3 or 4 years and you're doing $50 million a year in government contracting, you're going to have a cognizant auditing agency or a cognizant federal agency. And the basic structure of your indirects won't be arguable. Where they're going to start to pick is on what's an allowable cost to enter into your structure. So if Dennis is your vice president of business development, they're going to say, you know, we're not going to pay for his golf club fees. Get that out of there.
Come on. I work
So
hard for those fees.
that's the way that will evolve.
Yeah, that's a great point. Chris had written down on my whiteboard some stuff like that. I chose not to put it in, so shame on me, but allowable costs, you know, and he had some of the standard ones, you know, but yeah, that's where you'll start nitpicking. And sometimes it works to your advantage because anybody who, any officer, official officer, the whole salary can be indirect with our agency. So, you know, we're a small company. We got 2 officers. 2 of our guys can be fully burdened as indirect.
We did a lot of work for the Corps of Engineers, and our receivables to the Corps of Engineers were gold. They were, I mean, the point is they always got paid. The problem was sometimes they were late. Sometimes they'd go out 90 days, 100 days. So that meant connecting some dots from the discussion we've had this morning. I used to have to go to the bank and say, hey, listen, I need to borrow using this receivable as collateral. I need to borrow the money so that I can pay all of my payables that help generate that receivable. Well, that's fine, but that caused an interest expense. Okay. So I used to tuck interest expense into my indirects.
Ooh.
Thinking that the government should pay for the interest that I incurred because they were slow pays. And we argued about that every year.
Yeah.
And I never, trust me, you don't win those arguments.
No.
I don't know if the cost of money is still an allowable cost in indirects. No, typically
Most of the time
not.
it's not. Yeah,
Right.
I think I don't know, Anna, do you remember from your T's and C's? I think in our conversation, I think they were not.
So it kind of depends on how it's classified.
That's
Interest
right.
Interest is for sure not.
But
Um,
fee, they
but
might
a
charge you a fee. Yeah.
fee is allowable. So
Yes.
like, you know, again, I mean, yes, it makes a lot of sense to really read through the terms and conditions. And actually that's not even really in, those kinds of details are not really even in there. It tends to be a little bit up to like the interpretation of whoever's reviewing your indirect rate proposal
Right.
and everything.
Yeah.
But yeah, I mean, they matter because if you're setting something, you know, if you're setting something up with the bank, it's in your interest to like make the fee higher and the interest lower. And if it makes a difference to the bank, I mean, why wouldn't they do that?
Right.
So here's another interesting thought about indirects. And you know, take Dennis, for example. He's the CEO of a firm that's doing government contracting work. Now, when you bill your time as a direct to a contract, then that time can't be an indirect because it's a direct, right? But what about, let's say Dennis is the CEO, let's say 75% of his time is unbilled. 25% of his time is billed as direct, 75% of his time is unbilled. And let's just pretend for an example that all of his time is spent on writing proposals for the next contract. Okay? He can charge his time to proposal prep, and that probably is an allowable indirect. So the government, through its indirect payment to you, will actually pay you to write the next proposal. That's
It's
pretty cool.
definitely it's definitely allowable.
Yeah. So that's pretty cool. But again, back to Dennis's point, always, always, always leave a paper trail. And that means you're going to have a job cost tracking system, a timesheet system, all that sort of stuff. But the concept is what we're trying to lay out here. And that is you got to collect those costs and include them in different rate structures. Here, the example is an indirect rate structure so that you're able to get compensated for it.
It's a bailiwick.
Well, it's really in the weeds of understanding your cost structure and what your business model is. But as our Spark companies grow, it becomes a really important concept and a day-to-day management technique.
Yeah, I mean, a large portion of what we're talking about is valuable, like we said, to understand your business. A portion of it's minutia and you're dealing with government, and that's just unfortunately. That's why it's not free, right?
Right.
I mean, it's very inexpensive money. It's non-dilutive, very expensive, but not free money.
Right.
So.
Okay, any other comments, questions? Anything is fair game. We are nearing our adjournment. Dennis, tremendous job. Thank you very much.
My pleasure.
Wonderful for you and Three Roots to guide us through some tough technical details. Thank you.
You're welcome.
Okay, if
All
there
right.
are no other questions or comments, we'll stand adjourned.